What is a real estate commission plan? A commission plan is composed of a series of predefined rules to create a mathematical algorithm capable of calculating a desired result. Components within a real estate commission plan will include sale type, listing or selling side, the role the agent played in the sale; transaction type, in-house versus outside broker; production, agent's year-to-date closed commission performance; comparison type, how an agent's production is actually measured; performance levels, one or more levels in a commission plan with unique commission rates for each level. Agents can advance to higher levels depending upon their year-to-date production. Additional components within a real estate commission plan can include break-even point, total annual cost for an agent's expenses plus a reasonable amount or profit; level blending, the automatic combining of two commission rates when the agent crosses from one production level to another; commission year, agent's commission anniversary date; commission rate, a percentage to be applied to calculate the sales associate's commission amount on a sales transaction. The term sale type refers to whether the agent's role in the sale is listing or selling agent. Transaction type refers to whether the sale transaction was an in-house sale or included an outside broker. Production is the year-to-date commission amount that the agent has earned that is used to determine a predefined commission rate. Production should not be confused with the agent's taxable earnings, although an agent's taxable earnings is a possible comparison type. Comparison type is the commission amount used to accumulate the agent's year-to-date production for the purpose of determining the commission rate to be applied. Gross commission is a possible comparison type. Net company dollar, earnings, is another example. Using a comparison type creates a rule that determines how the agent's year-to-date commission production is measured. Performance levels are specific predefined rules that determine the agent's commission rate on a sales transaction based upon the agent's year-to-date production. Performance levels and comparison type work hand in hand with the agent's year-to-date production when calculating a specific commission amount on a sales transaction. The break-even point, or often referred to as the set point, is the total annual cost for one agent. Included in the break-even point is a reasonable amount for profit. In other words, how much does it cost to have an agent working at their company? A major ingredient for any commission plan is the break-even point. Commission plan performance levels can have one or more predefined commission rates assigned to them. Any commission plan performance level can have 4 different commission rates for specific sale and/or transaction types. Separate commission rates can be assigned to a level for a listing side sale, selling side sale, in-house sale, or outside broker sale. Level blending is the automated calculation that uses 2 or more commission plan performance level rates when determining the agent's commission on a specific sale. This automated calculation happens when the production amount on a closed transaction crosses from one performance level to the next. The result is a blended commission rate that uses the different rates from each level. The blending happens as the sale is being closed. Every agent should have a unique commission year-end date, often referred to as their commission anniversary period. The agent's commission year-end date can be totally different from a calendar year. The agent's birth date or when they joined the firm are often used as the agent's commission anniversary year-end date. The agent's commission year-end determines when the commission plan resets their year-to-date production amount to 0, which in turn starts to calculate future commissions using the first level of their assigned commission plan. The steps required to create a commission plan. Step number 1. Knowing your cost per agent. A major component of a commission plan is the annual cost per agent. How does the annual cost of an agent get calculated? Method number 1. Most broker owners will have some type of system to track income and expenses. Using whatever solution available, the first method to determining the annual cost per agent would be to subtract all commission payments from the total company's expenses for the year. The number remaining would be the company's total expenses for the year less commissions paid. Adjust the total expenses for non-recorded expenses. Example, if the broker owner is actively generating sales and managing their business, then the broker owner should add a management fee to their annual expenses for their time. Another annual expense often left out of the company's cost of operations, occupancy cost. In many cases, the broker owner may own the building that the real estate company operates from. In this scenario, the broker owner should factor into their company's expenses a reasonable rent for using the office space occupied by the broker owner's firm. By adding non-recorded expenses to the company's cost of operation, the real cost per agent can be determined. To establish the break-even point per agent, method number 1 simply divides the total company expenses less commissions paid by the number of agents in the firm. A simple example. Let's assume that the company's total annual expenses was calculated to be $200,000. Let's also assume that the number of agents in the firm is 15. The result is $200,000 divided by the 15 agents is $13,334. Add in a reasonable amount for profit. Assume $5,000 per agent per year. The adjusted break-even point is now $18,334 annually. Method number 2. The second method is more involved and requires more resources, and it will carry a cost. Method number 2 utilizes an outside consultant or financial institution to perform a full audit on the company's operating costs. Method number 2 will provide a very accurate picture of the company's costs and potentially provide a better amount for the break-even point for each agent. Method number 3. The third possible method is very simple. Divide the annual cost per agent into monthly amounts and charge the amount to your agents as a receivable. Using this method, the agent's commission rate will be 100% or very close to it. The broker owner in this scenario moves away from a traditional brokerage and becomes a landlord and service provider to their sales force. This video presentation assumes that the viewer is not using method number 3 and will be a traditional broker owner. Why is the break-even point so important? The break-even point is vital to the broker owner's ability to cover their business expenses and earn a reasonable profit when constructing agent commission pay plans. The faster the broker owner can capture their annual operating costs from their agents, the easier it is for the company to offer flexible compensation plans to their sales force and still enjoy financial success. This presentation will illustrate the significant importance of the break-even point and how it can determine the success or failure for a real estate brokerage firm. The broker owner must decide how the agent's production will be measured. This is important. The agent's comparison type is one rule within a commission plan. There are some standard comparison types for determining the agent's year-to-date production within a commission plan. These various comparison types are applicable to both the listing and the selling side of the sales transaction. These are the standard comparison types used in the marketplace today. Let's break down the standard comparison types used in many locations throughout the country. Gross commission example. In this particular example, where the sales price was $250,000 with a commission rate at 3%, the gross commission would be $7,500. The gross commission comparison type is the least complicated options. It also happens to be the worst option as well. This will become more evident as you continue to watch this video presentation. The next example is a gross commission less referral. where the sale price is $250, this commission rate 3% can be for either listing or selling side. We have a third-party broker getting 25%. So if the gross commission is $7,500, then the third-party broker commission will be 25% of that $7,500, or $1,875. So the gross commission less referral will be the $7,500, subtract the amount you're giving to the referral broker, which adjusts the new gross commission to $5,625. The gross commission less referral comparison type is similar to the gross commission comparison type, except this option reduces or adjusts the gross commission by subtracting any third-party referral broker commission. The agent portion comparison type starts to become a little more sophisticated. In this option, the agent's portion, that's the base that's used to perform the commission calculation, can be altered when one or more agents involved in the same side of the sale. The portion percentage can be whatever split was agreed upon by the agents assigned to the same side of the sale. Agent earnings example. We're going to use the same values from the previous example, where the agent's portion was $7,500 times 50%, or $3,750. The agent's commission rate was set to 50%. So the agent's pre-tax earnings would be $3,750 times 50%, or $1,875. The agent earnings comparison type drills down even further by using the agent's actual pre-tax commission earnings to determine the agent's year-to-date production. As illustrated above, the agent's earnings are calculated by applying the appropriate commission rate to the agent's portion amount. Net company dollar example. We're going to use a lot of the same numbers. Sale price $250, commission rate 3%. So the gross commission was $7,500. There's still two agents on this deal. Their portion splitting is 50%. So the agent's portion would be $7,500 times 50%, which is $3,750. The agent's commission rate is 50%. The agent's commission earnings is $1,875. So the net company dollar for this agent would be the $3,750, subtract the $1,875 that we paid the agent, leaving $1,875 as net company dollar. This example illustrates a sale where two agents are sharing the same side of the sale, can be listing or selling. If the other agent's commission rate was also at 50%, then the broker owner would receive $1,875 times 2, which is $3,750 in net company dollar earnings on that side of the sale. The net company dollar comparison type is one of the most common comparison types used by many real estate broker owners. The year-to-date production awarded to the agent's annual production amount is broken down to the company's actual revenue earned on the transaction. It's also the best option. It turns out that this comparison type is very popular because it allows broker owners to design commission plans using a break-even value that represents their total annual costs per agent, plus any amount for profit. Comparison types used in a sale, possible methods to measuring production. In our example, there were a number of different commissions. Gross commission was $7,500, the gross commission less referrals was $5,625, the agent portion was $3,750, the agent's earnings was $1,875, and the net company dollar was also $1,875. The question that the broker owner must answer is, how does the agent's production get measured? This is important because it sets the rules for the performance levels in the commission plan. Any of the 5 commission amounts in the sale can be used as a commission plan comparison type. In this example, the comparison type is net company dollar. Why? Because the production required values in this example reflect the net company dollar earnings. Notice that this commission plan example, that the required production amounts are much higher than the previous net company dollar plan. The comparison type production numbers now reflect the agent's portion. That's the commission amount prior to applying the agent's commission rate. This final example illustrates a commission plan with the comparison type being gross commission. Notice again that the production required values are much higher using gross commission comparison types. Even though the production required values are different, the amounts paid to the agents will not change regardless of the comparison type used. So why do we need different comparison types when designing a commission plan? There are a number of reasons for why the industry created more than one comparison type, but in most cases it's a regionalized cultural phenomenon. Using a predefined commission plan provides an automated method to calculating the sales agent's commission on any sales transaction. Using the agent's current year-to-date production amount, the sale type, the transaction type, and the agent's commission plan performance levels, the agent's commission rate can be determined and the calculation can be performed. The performance level required production values will reflect the comparison type used in the commission plan and compute the commission rate to be applied to the calculation. Assume that the agent's commission plan was set to compare the agent's performance level using the company's net company dollar comparison type. For our example, we will assume that the agent's year-to-date production was $10,250. We'll apply the commission values from the previous sale example to provide the logic used in the agent's commission calculation. In this example, we will assume that the sale type is a listing side of the sale. We'll also assume that the listing side was an in-house sales transaction. With these parameters, the automated commission calculation can be performed. With the agent's year-to-date production at $10,250 and the comparison type at net company dollar, the automatic calculation reviews the production levels within the commission plan and assigns the appropriate commission rate to the calculation. With the production level determined and the commission rate known, the agent's commission amount can be calculated using the appropriate rate for an in-house listing sales transaction. In this example, the agent's rate is 50%. Why are there 4 possible commission rates on a production level? Flexibility. Different market conditions could have different commission rates depending upon the sales transaction being calculated. In other words, commission rate incentives can be provided based upon the sale and transaction type. What would the agent's commission rate be if the agent's commission plan included blending and their year-to-date production was $17,900? As in the previous example, we'll assume that the agent's commission plan was set to measure the agent's performance level using the company's net company dollar comparison type. Let's change the agent's year-to-date production to $17,900, which is not visible on the screen. As you can see, the higher year-to-date production, the agent is very close to crossing from performance level 1 to level 2. Based upon the previous example, we calculated the agent's contribution to the company's net company dollar to be $1,875. When adding the $1,875 to the agent's year-to-date production of $17,900, we see that the new commission amount of the $1,875 increased the agent's year-to-date production from $17,900 to $19,775. If blending was not set in the commission plan rules, then the commission rate applied to the agent's commission calculation would be 50%. In other words, a non-blending plan ignores the fact that the year-to-date production crossed from one level to another. Therefore, the agent would receive a year-to-date production credit of $1,875, with the agent's portion at $3,750, and with the level 1 rate at 50%, the agent's commission amount will be $1,875. The net company dollar credit will be $3,750 minus the $1,875, which will leave $1,875 as agent production credit. When blending is set to yes in the commission plan, the commission calculation divides the $3,750 portion amounts into 2 sections. One section will use the level 1 rules, and the remaining section will use level 2 rules. Using the net company dollar comparison type, the calculation algorithm determines what amount crossed from one production level to the next. Therefore, the $1,441 will use Level 1 rules. The remaining amount, which is $434, will use Level 2 rules. The commission algorithm determined that the $3,477 is the agent's portion used for the Level 1 commission rate of 50%, which is $1,738.50. The remaining agent portion of $273 will be calculated using the Level 2 commission rate of 60%, which is $163.50. By blending the commission with a net company dollar comparison type, the agent will receive a commission of $1,902 as agent earnings, which is $27 more than the non-blended amount of $1,875. With blending, the agent earns a higher commission amount when compared to non-blending. However, with less commission going to the company's net company dollar, the amount added to the agent's year-to-date production will be $1,848 rather than the $1,875, or $27 less. Digging a little deeper reveals a few notable outcomes. First, when using net company dollar as a comparison type and blending, the agent contributed a lesser amount to their year-to-date production credit, even though they received a higher commission amount. So even though the agent earned more commission, their year-to-date production does not advance as quickly using the net company dollar as a comparison type. Using a commission plan with the net company dollar comparison type and the blending turned on, the agent will earn more commission from the sale, but it will take him longer to reach the next production level. What would happen to our previous example if the break-even point was lowered from the $18,344 to $17,500? With a lower required production amount in the Level 1 commission plan, the agent would qualify sooner and reach the next level much faster, which in turn would lower the company's earnings once the agent has advanced to Level 2. If you will recall, the topic of break-even point was discussed. Using a break-even point that is not accurate can greatly impact the broker owner's ability to cover their agent expenses and earn a reasonable profit. Regardless of the comparison type used in the commission plan, the required production values used for each level should provide a clear path to achieving the company's goals for financial success. What if the comparison type was set to gross commission without blending? With a commission plan using gross commission as the comparison type, the first observation is that the required production values are much higher than with the net company dollar comparison type. For our example, assume that the agent's year-to-date production credit is $70,000. With a gross commission comparison type, the agent's year-to-date production credit will be calculated based upon the gross commission, and their production credit amount will be significantly higher than any other comparison type. With blending turned off, let's break down the agent's production credit to be added to the current year-to-date total, and once that is known, calculate the agent's commission earnings. With the previously used sale example, the gross commission on the listing side of the transaction was $7,500. This amount is added to the agent's current year-to-date production of $70,000 and increases their year-to-date production to $77,500. Using the commission plan performance levels as illustrated in the graphic, the agent's new year-to-date production has crossed over to the next level. Remember that the year-to-date production is only added to the agent's year-to-date production when the sale is closed. But with the blending turned off, the algorithm ignores the fact that the agent has crossed over to Level 2 on this sales transaction. Therefore, the agent's commission rate on this sales transaction will be 50%, but their year-to-date production credit will be $7,500 of the sale, and with the new year-to-date production credit of $77,500, the agent will receive a higher commission rate on the next sale. What if the blending was turned on? In this scenario, by adding $7,500 to the agent's current year-to-date production of $70,000, the final commission rate to be used will be a combination of Level 1 and Level 2. It should be fairly obvious that when the blending is turned on, the agent will earn a larger commission compared to a non-blended calculation. Why? Because a portion of the calculation used the next level commission rate. In this example, level 2 was set to 60%. How does a blended plan using a gross commission comparison type affect the broker owner? It's bad. Why? Because with the blending, the agent got an increase in their commission earnings, and their year-to-date production was advanced to the next level as well. Unlike the net company dollar comparison type, where the agent received less year-to-date production, the gross commission comparison type rewards the agent both ways. It's even worse. Gross commission does not take into account third-party referral brokers, agents sharing the same side of the sale, or the possibility that the agent can earn a significantly higher commission rate. One last point on the break-even point value used in commission plans. With the break-even point known, the broker owner might decide to collect the operating costs by splitting the recapture over multiple levels on a commission plan. Instead of trying to collect the entire break-even amount within the first level of the commission plan, the broker owner can use a multi-level commission plan where each level promotes the agent's commission rate to a higher level before they collect all of their break-even costs. In other words, the first level of the commission plan will allow the agent to advance to a higher level and a higher commission rate without covering all of the break-even amount. In this example commission plan, the $18,344 break-even amount is split over 5 levels. It also rewards the agent with a higher commission rate each time the agent's year-to-date production crosses a level. It's pretty obvious that this commission plan will take the agent a much longer time period to cover the broker's break-even operating costs. It's not unusual for many smaller broker owners to get somewhat confused with the many rules and possible combinations when it comes to creating commission plans. That's why many broker owners select a reliable technology solution to process their sales transactions, and with predefined commission plans, let the technology make all the pieces work together. Although the break-even point within a commission plan is one method for recovering expenses, there are other options available. Here are some other possible options for recovering operating costs from your agent sales force. Off-the-top deductions. A sales-centric deduction subtracted from the gross commission prior to calculating commissions. Off-the-bottom deductions. One or more agent-centric deductions subtracted from the agent's pre-tax commission earnings. Administrative or marketing fees. One or more agent-centric deductions taken from the agent's earnings to pay for administrative or marketing activities. Accounts receivable. This option charges agents for specific expenses that must be repaid regardless of sales activity. Off-the-top deductions. The off-the-top deduction is considered to be a sales-centric deduction type. This means that the off-the-top deduction lowers the gross commission amount prior to calculating the agent's commission earnings. A very common off-the-top deduction is franchise fees. An off-the-top deduction is shared proportionally between the company and the agents in the sale. The higher the agent's commission rate, the more the off-the-top deduction is subtracted from their final commission amount. Off-the-bottom deductions. An off-the-bottom deduction is an agent-centric deduction type. This means that the off-the-bottom deduction amount is a specific deduction for each agent with no sharing of the deduction between the company and the agent. There are a number of ways to use the off-the-bottom deductions to cover operating costs and/or increase profits. Marketing or administrative fees can also be off-the-bottom deductions. Errors and omissions insurance can be another example. Administrative marketing fees. Another strategy to recovering an agent's annual operating cost is to levy various administrative or marketing fees to the agent's final commission earnings. These can be either fixed dollar amounts per transaction or be a percentage of any number of the commission values within the sale. This deduction type can be applied as an off-the-top or off-the-bottom deduction depending upon the strategy the broker uses to recover costs. Agent Accounts Receivable. Many broker owners will use an internal agent accounts receivable strategy to pass along fixed or variable costs directly to the agent. Unlike an off-the-bottom deduction, agent accounts receivables are owed to the company regardless of the agent's sales activity. There is no limit to the number of items that a broker owner can charge the agent using the agent's accounts receivable method for collecting operating costs. Recovering company operating cost strategies. Commission plans. With accurate break-even operating costs, commission plans are one method for recovering costs. Deductions. Using an off-the-top or an off-the-bottom deduction, the broker owner has yet another method for capturing specific costs directly related to the sale. Administrative or marketing fees. Administrative and or marketing fees are usually associated with a sales transaction and provide yet another strategy for recovering costs. Accounts receivable. This final strategy allows broker owners to charge their agents any amount that is repayable regardless of the agent's sales activity. Each of these various strategies can provide a path to financial success for the broker owner and still keep the company's sales force happy. Any one of these methods provided within this presentation can yield large or small amounts of revenue to recover costs and increase profits. Even smaller amounts from each sales transaction can add up throughout the year. Using a combination of strategies can balance the various methods used to achieving financial success. This presentation has thrown a lot of information at you. Can you see the various opportunities as a broker owner for achieving your financial goals? With unlimited commission plan options and combinations, how do you know what works and what doesn't? Is there a way to analyze, compare, and predict which commission plans accomplish your goals and which plans do not? This is where advanced technology can blow your mind. This image illustrates an advanced piece of technology capable of comparing one commission plan against another. Let's take a short tour of this technology and provide some insights on its abilities. At the top left is a commission plan used with one or more agents on one or more sales. A search feature within the application allows the user to locate any number of sales that are either closed or even still pending. The spreadsheet-like grid below displays a series of sales transactions that were found using the search feature. At the top right is the compare or predict commission plan that will recalculate all of the sales commissions on the sales found in the search. This is the experimental commission plan. The lower grid on the right side of the screen displays the same sales as displayed on the left side of the screen, except these sales illustrate the results of the calculations using the experimental forecast commission plan at the right top of the screen. The grid at the bottom of the screen shows the results of analyzing the calculations from both commission plans and displaying the difference between the two. Plan 1 is the original commission plan used on the sales transactions found in the search. The results on the right side of the grid illustrate the experimental commission plan calculations, and at the far right of the grid is the net difference between the two plans. At the top right side of the screen is the final predictive calculations, illustrating the results between the original and the experimental plan. A color-coded display shows a positive result as green and a negative result in red. In this comparative analysis example, the difference between the two plans results in an increase in the broker owner's earnings. A closer inspection of the two plans reveals that the experimental plan has the blend option turned on, the original is turned off. They both have the same comparison type and the performance levels, and the accompanying commission rates are exactly the same. With just one change in the experimental plan, turning on the blend option, clearly shows that the broker owner earns more company earnings on just a few sales found in the search. Imagine the difference when analyzing and comparing a larger number of sales transactions. Using this type of advanced predictive technology, a broker owner can test out various scenarios using their own actual closed or pending transaction data. Trying to figure out this type of sophisticated comparison using a calculator or a spreadsheet is extremely difficult, if not impossible. This would be especially true when trying to predict a larger number of sales. This video presentation has provided an advanced but still somewhat limited review of what commission plans are and how to use various strategies when constructing commission plans to achieve financial success. So what have we learned? In the end, it's all about profitability. Broker owners are in business to financially succeed, which means turning a profit year after year. Strategies and methods. The broker owner can recapture their break-even costs using a number of strategies and methods including deductions and agent receivables. Commission plan flexibility. A balanced commission plan strategy should be flexible enough to roll with the ups and downs of the ever-changing real estate marketplace. No one way is perfect. When mapping out a compensation strategy, there is no one formula for success. Analyzing various strategies using technology can be of tremendous assistance. Break-even point. A broker owner must accurately calculate their operating costs and set a break-even point for their agents. Even small changes can have a big impact. Using predictive technology to compare and analyze various commission plan scenarios can instantly illustrate how a small change can make a big difference. Blending versus non-blending. This presentation illustrated how blending can work for and against the broker owner depending upon the comparison type used in the commission plan. Technology can greatly assist. With the right technology, even smaller real estate brokers can gain a competitive advantage, or at the very least, keep up with the competition. A final word. Running a successful real estate brokerage, regardless of size, is more than just commission plans. A well-known and highly respected real estate trainer ran a survey every year for many years asking this question of his students. In order of priority, what are the 5 most important things you want from your real estate brokerage firm? Yes, compensation is on the list, but year after year, it was almost always the 5th item on the agent's list. Real estate agents are people first. Although they play a role as a salesperson, underneath their often bravado is a sensitive individual with needs and wants that go beyond money. Treating a sales force with respect and appreciation goes a long way to achieving your goals that you've set for your real estate brokerage firm. Thanks for taking the time to watch this video presentation. It is our hope that you've gained more insight into commission plans and their importance in your long-term success.